What if I told you that most accounting mistakes are not made during the year? They happen right at the very end when businesses try to close their books. That one rushed step can throw off an entire financial statement. Today, we are fixing that. Welcome back. In this video, you are going to learn exactly how to complete the accounting cycle, from adjusting entries all the way to closing the books. By the end, you will understand the full picture of how raw financial data transforms into clean, reliable financial statements. And trust me, once you see how all the pieces connect, accounting starts to make a lot more sense. Let us get into it. Section 1. The adjusted trial balance. Before a business can prepare its financial statements, it needs to make sure every account reflects what actually happened during the period, not just what was recorded. That is where the adjusted trial balance comes in. You already know about the unadjusted trial balance. That is basically a list of all account balances, before any end-of-period corrections. The problem is, some transactions happen over time, like rent paid in advance, or salaries that are owed but not yet paid. Those need to be updated before you can trust any of the numbers. So accountants make what are called adjusting entries. These entries fix things like prepaid expenses that have been used up, revenues that have been earned but not yet recorded, and expenses that have been incurred but not yet paid. Once all those adjusting entries are posted to the ledger, you run a new trial balance, the adjusted trial balance. This version shows all accounts at their corrected balances. Think of it like proofreading a document before printing it. The adjusted trial balance is your final proofread. Now here is something that might surprise you. The adjusted trial balance is actually the foundation for all three major financial statements. So how exactly does one list of numbers turn into three different reports? Keep watching, because that is exactly what comes next. Section 2. Preparing financial statements from the adjusted trial balance. Once you have your adjusted trial balance, you are ready to build the financial statements. And the order matters here. You cannot jump straight to the balance sheet. You start with the income statement. Pull all the revenue and expense accounts from the adjusted trial balance. Revenues minus expenses gives you net income, or a net loss if expenses are higher. Next, you move to the statement of retained earnings. This takes the beginning retained earnings balance, adds net income from the income statement, and subtracts any dividends paid out. The ending retained earnings number you calculate here feeds directly into the next statement. Finally, you prepare the balance sheet using assets, liabilities, and the ending retained earnings you just calculated. Everything connects. Each statement feeds information into the next one like a chain. This sequence is not just a convention, it is necessary. You literally cannot complete the balance sheet without first finishing the income statement and the retained earnings statement. Pretty elegant, right? But what happens to all those revenue and expense accounts after financial statements are prepared? They cannot just stay open forever. There's a special process for clearing them out, and that is where the next section gets really interesting. Section 3. Closing entries. Here is a concept that trips up a lot of students: closing entries. At the end of every accounting period, you need to zero out the temporary accounts. Those are your revenues, expenses, and dividends. Why? Because these accounts only track activity for one specific period. If you left them open, next year's numbers would mix with this year's, and your financial statements would be completely useless. The closing process works in 4 steps. First, you close all revenue accounts by debiting them and crediting a summary account called income summary. Second, you close all expense accounts by crediting them and debiting income summary. Third, you close income summary itself, transferring net income or net loss into retained earnings. Fourth, you close the dividends account directly to retained earnings. After this process, revenues, expenses, and dividends all have zero balances. They are wiped clean and ready to start fresh in the new period. Retained earnings, on the other hand, is a permanent account. It carries its balance forward indefinitely. One quick way to remember which accounts get closed: ask yourself, does this account appear on the income statement or as a dividend? If yes, it gets closed. If no, it stays open. So after closing, how do you know the books are actually balanced and ready for the next period? There is one final checkpoint, and it is simpler than you might think. Section 4. The post-closing trial balance. After all those closing entries are posted, you run one more trial balance, the post-closing trial balance. This one only includes permanent accounts, assets, liabilities, and equity. All the temporary accounts should now show a zero balance, so they do not appear here at all. The post-closing trial balance serves one main purpose. It confirms that debits still equal credits after closing. It is basically a final sanity check before you move on to the next accounting period. If your post-closing trial balance does not balance, something went wrong in the closing entries. Maybe a debit and credit were entered in the wrong account, or a balance was transferred incorrectly. Either way, you catch it now, rather than letting an error carry into the next period. It is a small step, but skipping it is one of the most common mistakes beginners make. Think of it as locking the door after you leave. You could skip it, but you really should not. Now, some companies also use an optional step to make the next period even easier to start. It is called reversing entries, and knowing about it can save you a serious headache. Section 5. Reversing entries and the full cycle. Reversing entries are optional, but they are incredibly useful. They are made at the very beginning of the new period, and they simply reverse certain adjusting entries from the previous period. The goal is to prevent double counting. For example, if you recorded an adjusting entry for salaries that were earned but not yet paid, you might reverse that entry at the start of the new period. That way, when the actual paycheck is issued, you do not have to remember to account for the portion already recognized. The reversal handles it automatically. Not every adjusting entry gets reversed, typically just those involving accruals, like accrued revenues and accrued expenses. Prepaid items and depreciation are generally not reversed. And with that, you now have the full accounting cycle, from journal entries to the trial balance to adjusting entries to financial statements to closing entries to the post-closing trial balance and, optionally, reversing entries. It is one continuous loop that repeats every single period. Understanding this cycle means you understand how every financial decision a company makes eventually shows up in its financial reports. That is a powerful thing to know. Understand how A2 Gontro. So, let us recap. The adjusted trial balance corrects your accounts before statements are prepared. Financial statements are built in a specific order: income statement, retained earnings, then balance sheet. Closing entries wipe out temporary accounts. The post-closing trial balance confirms everything balanced. And reversing entries help you start the next period clean. If this video helped you connect the dots on the accounting cycle, do me a quick favor. Hit the like button. It genuinely helps more students find this content. Subscribe if you want to keep building your accounting knowledge one concept at a time. And drop a comment below. What part of the accounting cycle has been the most confusing for you? I read every single one, and it helps me make better videos for you. See you in the next one.